Hey, what's going on? Wow. So it's been a minute. Um, I guess that we missed a week, maybe 2 weeks. Not really sure. Lost track of that one. But anyways, hopefully everybody liked that festive intro. I threw that together so you could see that we are in the Christmas season, and at the Financial Mirror, we like to keep that in mind because obviously there is a big thing where finances can become a huge issue around Christmas time. So, with that, this is a episode that I was gonna do last time. Ran into a little uh, personal thing and took off just a little bit, but we're back. And let me know if there's any audio errors, any audio issues, because obviously this is a new little setup with the new screen, and some of the settings didn't come over and how to try to fix them. But anyways, what I'm going to go over is mutual funds, okay? And the big thing that I want to cover with mutual funds is the fact that mutual funds can obviously make you money now, but it can also make you money later. So that's what I titled the stream, because um, making money with hold on one second. All right. So making money with them is obviously a way that we can make sure that we are invested, obviously, but we can also make sure that we are making the financial decisions that we need to. So, hey, Pippa, welcome. Glad to have you here. So the biggest thing I'm going to go over. So this is completely live. Um, this is completely off the top. I haven't planned much of this because I wanted this to be as realistic as possible. I didn't even go over this. Look at this. So we got our shirts. Boom. Financial Mirror shirts. I've got some of the. I've got this one as well on the website. So if you need a good Christmas gift, this is them. So you've got. Yeah, just hold in front of my face. If you're catching this on the podcast later, just go to financialmirror.org and go to the store, and you can see the the swag that we've got. But if you look right here, this one is I think it's $1 more. I sold it at cost because obviously this is a walk-in billboard for me. But it's got all the social media handles on the back. So if you want to pick that one up, go ahead and pick it up. It's online, gray, black, white, and then once again, if you're still not picked up your mask, boom, we've got mask for everyone for the COVID. So, anyways, back to the mutual fund. So I'm going to quickly go over what they are. We've gone over this on previous episodes. I'm going to quickly go over what they are. I'm going to quickly run down how they work, how you make money off of them, and then I'm going to show you how to find them. And then build out what you've got, what you have to do. So, starting off, so like I said, for anybody on a podcast or just catching this later, this may be one that you want to go watch live, and it's on YouTube, Facebook, and Twitch, obviously. So if any of this doesn't make sense from an audio perspective, please go tune into this and go try to catch it on the live stream so you can see where we're going with some of this stuff. But anyways, so mutual funds, what are they? So if you can think about a mutual fund, what you can think about is this big pot of money, right? And fund managers, whoever the fund manager is, what they do is they go out and they obviously market their fund, right? And what we're technically investing in is mutual funds that are either based around stocks or bonds or cash or something of that nature, right? So these fund managers are going to go out. They're going to have this big bucket of money they're going to collect. And then whatever their fund is based around, that's what they're going to invest that money that they collect into. So when you put money into it, what you're technically doing is you're helping invest in whatever their fund is based around. So making sure that where your money's going is where you want it to go is step one. Finding things that meet that criteria is step two. And you've got to make sure that you've built a plan around how you want this money invested. So conservative, moderate, aggressive plan types. It all depends on what your ultimate goal is. And if you have a plan and you need to figure out where you want it to go, that's where I can hopefully help you. So before we look at it, how you make money off of these is very crucial to understanding. So what happens is that you don't make money off of, like, so let's say you have a fund, right, and they invest in big companies like your Apples and your Googles and your Amazon, so forth, so on. You're not making money, even though these portfolios are made up of all these huge, high, big name stocks. That's not technically what you're making money off of. So what Apple does and what Amazon does and what they're doing is not technically where you're making money. Now, is that contributing? Yes, 100% that's contributing, but it's not where you're making your money. So where you're making your money is off whoever that fund manager is. They're going to make money off of that fund. Everyone's hitting me up today. Nice and busy. All right. Still got me. So where you're making your money is when all these funds are adding up and they are technically making money. They're going to redistribute those earnings to everyone else. Okay? That's where you're making your money, not off the individual stock's performance per se. Okay? So whenever you come up with where your money is going to go, that's where you have to come up with this plan. You have to come up with this idea and then figuring out how to diversify that portfolio. So the buzzword obviously is diversification. Everyone's going to talk about it. Everyone's going to tell you that you should diversify. The problem is that when you're going through and doing portfolios and you have no experience of what you're looking for, you have no idea how to diversify. And the problem is that there's a ton of companies that are out there that are obviously going to try to get your business into their mutual fund to help, because obviously if you're helping fund them as well, because wherever all this money's going is where they're trying to make their money as well by using your cash. So ultimately, they want you invested in their fund. They want you invested in their portfolio. So the idea here is to invest. So the first thing I want to tell you, the first step into all of this is start investing. It doesn't really matter. Where you're investing it. I'm going to show you how to start. I'm going to show you how to look at them. But it doesn't really matter where you're investing it as much as just start investing, because the idea is that making money on mutual funds is consistently investing for a longer period of time. If you want to make money off of stocks, options, stuff like that, that's a little bit quicker turnaround on your cash, but obviously more risk involved. So for mutual funds is a little bit simpler, because obviously you can go in and choose the mutual fund you want, and then go from there. So you can, if we Google, so let's pull up Google for any of the podcast listeners that are out there. The biggest thing that I want the podcast listeners to see or to hear or to know is that we've got. I'm going to go through a little bit of this. It's going to obviously require you to see some stuff. So, like I said, go catch it live on an actual stream, YouTube or Facebook, Twitch. to catch this. But we're on Google, and I'm gonna walk through. This is the first time that I've done a mostly visual type of stream, so I'm gonna walk through what I'm going through visually. I'm gonna walk through and sort of walk through saying it. So just on Google, and I'm just gonna type Google mutual fund diversification. So let's look at that. And if we went in and I'm going to go to images, and you can see here on the images where there's tons and tons of, I'm not even going to click on them, or it doesn't really matter to me. What you can see is that there's tons and tons of ideas. There's tons and tons of objects that are out there that's going to help you, that's going to try to get you to invest in their strategy for mutual funds. For this one's international growth and income, growth and aggressive. This one right here is a Dave Ramsey strategy. So, and I'm going to go over Dave's strategy. Dave has a great strategy, but Dave's strategy is very cookie cutter. So it's and if you don't know what you're looking for, I'll show you. But you can't really mess up, but you can end up having a portfolio that's not really diverse, even though you think it's diverse. Okay, so going into it, the first thing when you're going through these mutual funds is figure out what type of portfolio are you going to set up. So a couple different ones that you can choose from, obviously. Aggressive, moderate, conservative. So aggressive is, this is going to be backwards than what you might think. Aggressive, you might think we're gonna make some quick cash. We're gonna make quick money, and that's that, right? The problem is that that's not technically the case. When you're going with a more high risk portfolio, you really want that to be a long-term strategy, because when you go into an aggressive portfolio, the portfolio is going to change dramatically. It's going to change rapidly. It's going to have its ups and downs, and it's going to move through that quickly. So when it drops, you've got to have the time that you're willing to invest to say, I'm going to hold on to this for the long haul. I'm not going to cut out early. I'm not going to lose my money, but I'm going to go in this for the long haul. So with an aggressive portfolio, you really want a 10-year or more time frame to have that money invested. That allows the market to fluctuate, but in the end, you to be able to come out profitable. Okay, moderate. I'm gonna skip moderate, because moderate is pretty easy. 5 or more, just cut it in half. 5 or more years, so forth and so on. Conservative. This is a more steady growth of your account. Obviously, less risk. 3 or more years is the recommendation. What I say is that if you just want something that'll grow a little better than inflation, conservative risk is where you want to go. But that's the thing. You can have an aggressive portfolio that's going to grow and give you gains, but stick conservative bond type mutual funds in there. And that's what I'm going to show you. What that does is that allows part of your portfolio to grow and have those big swings and ups and downs, and the other part to be a little bit more conservative, low risk, that allows you to be able to tolerate those swings and offset that with hey, thanks for the subscribe, prime time. So wow, 4 months, man, that's pretty good. So the big thing is understanding that you've got to choose, and you got to go from there. So I'm going to start out. If your first thing is where to invest mutual funds, if you Google mutual fund brokers or investors or whatever, you'll see tons and tons and tons. Top mutual fund brokers. Here's some. So best brokers for mutual funds. Yeah, like I said, there's tons. TD Ameritrade, Vanguard, Fidelity, Ally, Charles Schwab, blah, 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 blah. It doesn't really matter. Pick one. It really doesn't matter. Pick one. They're all great. Pick one. So that's that. All right. So you have that. You have your broker. The biggest thing to look at in broker, and I've gone over it in a previous video, is just look at fees. The fees is the number one thing that's going to drive you from one broker to another. So with that, your one-stop shop, where I want you to write this down. If you've never seen it, you don't know anything about it, write this down. It's called Morningstar. All right. So with Morningstar, what Morningstar does. So let me pop this up and I'm gonna sign in real quick. Always do this so that obviously don't want my information taken, but also don't want your information taken. So make sure that you always keep privacy forefront of your mind. All right, bingo, we're in here. I think we're in here. Yep, we're in here. All right, cool. So back to here. So we are at the Morningstar. Not the Morningstar, but Morningstar. All right. This is where I want you to know that you can find information around mutual funds, all types of mutual funds, every type of mutual funds. I'm gonna go research and go to mutual funds. It's this top right under Morningstar, and you can see tons and tons of mutual funds. You can go to ranked mutual funds. Here's the different mutual funds right here. Like I said, here's one. You can just look at these. So large value, large blend. So blend is a blend of value and growth. Growth is going to be more aggressive. Value is going to be obviously more conservative. This stands for capitalization. So mid capitalization. So these are large is more conservative in a sense that they're bigger name companies like your Apples and Microsofts, and they don't fluctuate a lot. They fluctuate, but not a lot. Mid cap's that mid level company, and then small is obviously your small higher risk mutual funds, just smaller companies, less background around their finances. Real estate funds invest only in real estates. World large stock funds, foreign large blend funds, blah, blah, blah. You can see you can invest in any kind of fund you want. Look at all these high yield bond funds, corporate bond funds, index funds, yada, yada, yada. All of this is funds that you can invest in. This is what I'm saying. There's tons and tons of funds that you can invest in. So don't get wrapped around the funds right now. We're going to get to that in just a second. So the easiest way to diversify or to get your money's worth out of the fund you're invested in is to invest in a couple of different ones throughout here. So that's the goal of this. And I'm going to go back and I'm going to say this because I want everyone to have one. I want everyone to have one simple thing that they focus on, and that's this. Just invest. Don't get caught up in the fun. Just invest. Look at Morningstar. Look at the ratings. Look at the risks. Accept your risk tolerance and go forth. So the biggest thing is just invest. Start investing in these things. So I'm on Morningstar. I'll scroll down right here at the bottom. I've got all of these funds. So I'm going to start out and I'm going to look at a large blend fund. So actually, separate all these, but ultimately, if you want to do a more aggressive fund, you're going to get into sort of like an 85% stock, 15% bonds type of thing. So a lot of yours is going to come from this area right here, these large, mid-cap, small funds. And then you're going to come and you're going to get a couple of the bond funds right here. And that's a good portfolio allocation. So just remember 85% coming from here, 15% coming from this area. If you want to go with like a more moderate fund, it's going to be 65-ish percent, 35. I don't want to give percentages. Just figure out your risk tolerance and accept your risk tolerance. I'm giving you some very simple comparisons. A more conservative is take more of or less of these, more bond type of funds, and go with that. But what I want to show you is how to find mutual funds, how to figure out all of these things about where the mutual fund is, what you're going to do with it, so forth and so on. So here's what I want to show you. So I'm going to go to mutual funds, and let's find basic fund screener, whatever. I said scanner, screener, same thing. So this is where you can obviously go off of that recommendation of looking at where your tolerance level is, and you can choose. So obviously, right here, we would do some kind of U.S. equity company type of thing. So I could do all, but and then just search off. This is probably what you're more familiar with. So let's do a large blend fund. Let's look at all the large blend fund. So this minimum initial purchase less than or equal to. So what this means is that you need to open an account with this mutual fund, is they require, like in this sense. So let's do less than or equal to 500, meaning that you have to invest $500 up front to open this fund, to invest into this fund. Okay. Next, we'll look at we'll do 4 and 5 star. This is Morningstar's ratings. Morningstar is a very well known, predominant mutual fund website. So, or actually just investment website, really. But go off of that, and then I'm not gonna do a return rate, but I'm gonna sort by return rate. Okay. So, and once again, I've not done this. This is completely live. If you're watching this on the podcast, or listen to it, watching it, if you're listening to this on the podcast, just know that this is completely live, and which you may go and do this on your own, or if you're following along just through audio, just know that this is what you're seeing is obviously going to be different than what I'm seeing. And then right here, this for these type of things, turnover, and you want to see a lower turnover, normally speaking, in funds, and that's because what a turnover is how often are they switching out the stocks that they're invested in their portfolio. Meaning, if they're constantly switching them out, there's a high turnover of the stocks that are in that portfolio. That normally leads to less confidence in their decision. So if the more competent the fund manager is, the more confident they're going to be in their decision to invest in certain stocks, and they're going to hold on those, leading to a less of a turnover. Okay, so this is all I'm going to do. I'm just going to look for 4 and 5 star large blend, $500 less than. Okay, show results. Boom. Now this is the year-to-date return. Let's view. So I'm viewing by performance. What I want to look at is those 10-year returns. So I want this to be, like I said, I'm going for a more aggressive mutual fund, possibly moderate mutual fund here. And I want to look at good return ratings for my money. So if you're looking at on this and your 10-year return rate is nothing, and this asset, this mutual fund has not been out for 10 years to acquire that return percentage, may not be one that you're comfortable investing in. So let's look at our top return percentage. So in this one, I've got the Hartford Core Equity R5. This is a large blend fund. It looks like it's averaging 15-ish%. So this year, you can see a lot of funds did better because the market was a little all over the place due to COVID. So if you had a good fund manager, they were obviously able to give you a higher return rate, because they probably did have a higher turnover rate as well. But ultimately, this is what you want to look for. Morningstar risk. Morningstar, you can see these below average, above average risk levels. This is where you need to say, okay, so if this was all like above average, and you're like, above average is too much. These are all large blend funds. Let me see what else I can find. Let me go with something else. that's where this risk level would go into it. So for now, I'm going to open up this top one, 14.99% 10-year return. So I'm going to open this up. It's got a 5-star rating, roughly. Let's see. I didn't even look at look at that minimum initial investment. That's all I was looking for. $0. So $0 investment. So you can start out with as little as $1 to get into this mutual fund. So this is step one. This is the first thing that you're doing. You screened them. You found it. You're like, this is the one I'm going to go with, and that's the one you choose. That's step one. Let me back up. That's my rewind sound. So let me back up. The first thing you do is figure out your portfolio type: aggressive, moderate, conservative. Balance that out to be, going back to our original example. I'll come down here to the bottom. This is the bottom of Morningstar. More of these, meaning means more aggressive. Half of these, sort of a moderate. Less of these. Let me back up. So my podcast guys don't even know what I'm talking about. More large, mid-cap, small funds. Less bonds. More aggressive. More are the same large, mid-cap, small as to bonds. Moderate. Less large, mid-cap, small to more bonds. Conservative. Figure that out first. Figure out where you want your money to go, and then just invest. If it's all in one, if you want to make it really easy, go 75. If you want to go aggressive, to go 75% in a large blend fund, and then give you a 25% in a bond fund. Boom, you have a more aggressive. Now you can get even more aggressive by taking that 75% and doing 75% in a large blend, 25% in a large blend, 25% in a mid cap, and 25% in a small blend. Boom. These are very, very different. Everybody's portfolio is going to look different, but start investing. So you've figured out that you found, here's a large blend fund, and I want to do 75% return. I can do that. Now, so I'm going to do my handy dandy Google Sheets. Now, what I want to show you when it comes to Google Sheets here is this guy. So our 10-year return. So I can go to performance. These tabs right here. Some of these tabs are going to be premium tabs only. So if you don't have a Morningstar premium version or whatever they call it, you're probably not going to be able to see some. But 10-year 14.99%. So if I did, we'll just say, so this is HGITX, and I'm going to do 75% into that fund. What I want to show you is this. So let's say that if you just search top mutual funds, the issue that you're going to have is that there's this thing called overlap. Okay. With overlap is where two funds, the stocks that they're investing in. So if I scroll down on this stock to portfolio, if I choose portfolio tab and I scroll to the bottom of one of these funds, what you can see is the stock allocation of this portfolio. So right here, you can see the top holdings that are in this portfolio: Apple, Amazon, Alphabet, which is Google, Microsoft, Facebook, Procter & Gamble, United Health, JP Morgan, Salesforce, and I can look at all of them. I can see everything that this portfolio holds. Okay. Now, the thing about it is that this portfolio is going to have, if I went to, let me go to another one. Let's go to JP Morgan's. So I'm going to open JP Morgan's. I'm going to go to their portfolio, and their top stocks are going to be identical, if not the same, as that one. Look at that, just in a different order. So Microsoft, Amazon, Google, Apple, MasterCard. All right, so MasterCard wasn't there. NextEra wasn't there. Eaton wasn't there. Norfolk Southern wasn't there. Prologis wasn't there. Northrop Grumman, Netflix. Okay, so their top 1, 2, 3, 4 are the same. So if you were looking at this, you could easily say that I could possibly, well, no, hold on. So no, no, they're all there. MasterCard, I got ahead of myself. MasterCard, NextEra, they're just a little further down. But anyways, you could technically say that you could split this and go 40-35, right, between these two, and you could get a little bit different of a return because you have less overlap. Overlap is where a lot of these are the same. So you've invested in two different funds, but those two fund managers are invested into the same stuff. So you've practically invested into the same stocks, equaling the same rate of return as long as the payout's the same. And that's kind of you. So if you invested 100% into two stocks that are completely overlapped, if one mutual fund tanks, your diversification is terrible because the other one's going to tank too. They're invested into the same thing. So the whole idea of diversification is that if one tanks, you've still got 3 or 4 mutual funds that are going to hold your account together. You see what I'm saying? Okay. So perfect. So that's where this would go into 75%. You could break this out and then see where these are different. There's paid programs out there that you can actually do overlap comparisons between these type of mutual funds. But I'm not really going to get into all that. What I want you to focus on is the mutual fund, how to find them, comparing them as we just did here. And this, look at this. This would be my selling point. 84% turnover to Hartford's 15% turnover. I'd probably just take my 15% turnover and roll the dice. You're talking a 0.01% difference. And or no, I'm sorry. 14.9, and then we did JP Morgan 14, so 0.50% difference. So I'd roll the dice. I'd take the 15% reported turnover and go from there. Pretty much same equities, so forth and so on, and both are updating frequently. So, I mean, yeah, I would probably take the 15%, and this Hartford Core Equity would be the one I'd roll with. So that's just going off of this one metric. So all we've looked at is this one. Now, what I want to go to now is I'm going to go back to Morningstar Screener and change this to a mid-cap growth. And let's compare. So show results on this. Change this to view under performance. Filter by the 10-year percent return at 19.84. So this Delaware looks like it's a small mid cap, or unless it's Delaware S. Let's see. Yeah, it's a mid growth. Okay, we'll take it. 0% initial investment. So if you wanted to go a little bit more aggressive, you could throw a mid cap in there. If I looked at this portfolio, you're not going to see those same stock layouts. Look at there. You're not going to see those apples. You're not going to see those. Now these are probably still very well-known companies, right? They're mid-cap stocks, but you're not going to see those apples. You're going to see. Let's see what I recognize: Yeti, Planet Fitness. DraftKings, ordinary shares. Yeah, that's pretty much it. It's pretty much all I got. So huge turnover on stocks. Not as fluid. Great return. 10-year stock. I mean, it's still a good mid cap stock. So what did 5-star rating from Morningstar? I mean, it's tomato. So the big thing is just getting in there, finding that, and then I'm going to just, for giggles, I'm going to go in and do a small cap as well so that you can see the small growth and you can see the difference. So show results. Go back. We're going to do performance. 10-year percent return, 17. So the small cap growing a little slower. AB, small cap. What is this one? So we got the Hartford Core Equity, the Delaware Mid Cap Growth, and then the AB Small Cap Growth. So let's go to Portfolio $0 investment on this one. So a solid aggressive growth strategy would be this one. You'll probably know none of the companies, most likely, just so you know. So this one you're going to do, if you recognize any of these, amazing. Texas Roadhouse is probably the restaurant. That's probably the only one I got. Sleep Number, I got that one. But yeah. But if you did this and you did 25, 25, 25, 25 of the small cap, 25 mid cap, 25 large, all being the blend funds, that's a solid aggressive. And then if you throw a 25%, a 25% bond on there at the end, that's a fairly aggressive portfolio that you could roll with. But that's all this. That's all mutual fund buying is go through, find the mutual fund. Don't chase returns. I want to stress that. Don't come in here every 3 months and change based off of what the new 10-year return or what the new year-to-date return is. They've been pulling this out for the last 10 years, and in comparison to all these other guys, they're still holding strong on 10 years return. So the biggest thing is don't chase return percentages. Okay, don't chase return percentages. And then risk levels, obviously look. I didn't even look at risk levels on some of these other ones, but look at the risk levels on them. So fund analysis is a pro feature. So look at the risk analysis on them, see what the risk is for that particular fund, and then go with it. Go with it. I'm telling you, just go with it. It's not as hard as people put it out to be. It's really not. If you want to do faster money, if you want to make money off of these things, you can. You absolutely can make money off of mutual funds, and you could say, I'm going to make annual money off of these. I'm going to cash out, like I'm going to sell and cash out. Like you can do that. It's not hard to do, and you could easily get, depending on how much you're invested, you could easily get a couple thousand extra dollars a year based off of that alone. So, or a couple extra $100 or whatever. Just it's all based off of what you want. But it's not as cookie cutter as, oh, just do 25% in this, 25% in this, 25. Like, no, it's like you have the ability to take mutual funds and diversify them. So I'm gonna pull up something real quick because I stream this on the podcast now. You'll know I have there's an ad that runs. So I'm going to take a quick ad break and be right back. All right. So what I want to look at is I'm going to do a quick bond. Let's find a bond. Let's do like maybe a multi-sector bond. Let's try that. Multi-sector bond. Yeah, 6%. Yeah, you can do something like that. Let's see. 6% is probably about right for our bond. Multi-sector. What else we got in here? Corporate bond. Yeah, I think our multi-sector. Anyways, we'll do this one. We'll look at this. Voya's bond investment grade bond. So $0 minimum investment, and then we'll do this for you. So ISCFX. ISCFX. So what you all, if you've been watching this through the entirety or listening on the podcast, what we've done is we've pretty much taken a large blend, a mid blend, and a small blend fund, and then a bond fund, and put it into what we're going to call our portfolio. So I didn't get all of these, but let's just say that, let me go through and get all of these returns. If I'm not mistaken, it was like what, 19? Actually, what I'm going to do, how do I want to do this? So I know this one was like 19%. This one was like 19%. I want to say they were all 19. Were they not? Pretty sure all of these were 19%. Let's go performance. Let's look. So here's what I'm trying to decide. I'm trying to decide if I want to show you. So I'll do both. How's that sound? I'll do both. I'm going to show you how much a short-term investment would have made you, and then how much a long-term investment. So for Voya, 12% year to date, 6% 10-year. So we'll do short and long. So 12%, 6%. So if you're going to go on, if you're going long on a longer term investment versus a shorter term, that's what I'm going to compare right here. So 10-year 17, year to date 44. So 44, 17. Mid cap is 81 and 19. Obviously you can see I'm rounding these, 81 and 19. Shorter term is, or sorry, large fund is 16 and 14. I thought that was higher. Or maybe it was 14. 16 and 14. So I'll make that 14 to make up for the difference. So 16 and 14. Sorry for that. 16 and 14. All right. So this is our split of our money, right? So total investment, and you know I love Google Sheets, so I'm gonna try to build this out. I normally try to keep these so that you can use them in the future. If you ever wanted, you could easily ask me and I'll give it to you. So total investment. So let's say that we have a $15,000. Actually, we'll do a $20,000 portfolio. So this is going to equal this times this. Yes. No, not that. That. No, not that. Okay. Okay, I don't know. I don't know why that's not feeling right. But anyways, this was an easy math equation, but obviously you can see that this could be more complex later. But so if you took that, and then I'm going to insert one to the left. How am I going to do this? Oh, that's not. Oh, that's why. These should be numbers or dollar amounts. Yeah. Why does it say are these percentages? There we go. All right. So this would be this times this plus this. All right. Now, this is going off of a year now. This is what I want you to see. Your 20 after a year, your 27,000 or your 20,000 would have been 27,650. So if you see that, or as you can see, this could be a short-term investment. So this, using these mutual funds, we went through and we grabbed small. This is a bond, small cap, mid cap, large cap fund, blend funds. These are all blend funds. You could have turned that money into 20,000 and 27,000 a year. These are year-to-date returns. Okay. So now let's do a longer-term return. So this is the part with the long term that I want you to try to help our equation. This is what I'm going to do. I'm going to use these now because we're going to say that after the first year we've grown this much. Here's the part. What I've told you is that you've got to invest and keep putting money into it, right? So with this, if I went off the 20,000, I could easily do that. I could say, okay, $20,000, we're good. The problem with the 20,000 is that you can't say your 20,000 is going to be 20,000 next year because obviously it grew to 27,000 in 1 year. So, and without you putting any more money into it, it was 27,000. So I'm going to use these numbers, but you have to realize that these numbers are actually going to be higher. But just for math's sake, if we did this times this plus this, $31,000, and this would be a longer term look at it. So obviously the numbers don't really add up in a sense of what they would be if you were actually going off 10 years, because you'd have to multiply these type of gains by 10, and these are not going to be the same every year. So there's no real way to estimate what they would be. You can't really estimate the market. But this would be based off of if you took these gains and just reinvested them. Like I said, there's no real way. I think this shorter term is the way to look at it and say, okay, well, this is how much, if I wanted to make it from a financial right now money perspective, this is how much I can make. So this would have been how much you'd have made. Your 20,000 would have turned into 27,000 in 1 year if you would have invested in this portfolio at 25% in each fund. So hopefully that makes a lot of sense. Like I said, email me, go to thefinancialmirror.org, email me if you have any questions. I don't mind helping one-on-one, helping people out, getting them what information they need. But Morningstar, that's going to be your go-to area. So hopefully everyone enjoyed that. Hopefully everyone got something out of it. I really hope. And if you like I said, if you have questions, please let me know. I truly do not mind helping you out. So if nothing else, appreciate your time. I look forward to seeing y'all next week. Peace.